You could even have a visualization where you imagine that there's a layered stack of blocks, and the base layers are more stable because those are lower risk, and the upper layers carry more risk, but obviously offer more returns if you can build that tower out of blocks bigger and bigger and taller and taller.
Welcome to Alt Investing Made Easy, where we explore the complex world of alternative assets. I'm Roland, a securities attorney, investment advisor, and your co-host.
And I'm Sarah, an investment advisor and corporate attorney, and your other co-host. We'll guide you through real estate, private equity, and more, making complex topics accessible.
Tune in for insights that empower your financial journey.
Let's make alt investing easy, one episode at a time. Welcome everyone to Alt Investing Made Easy. Have you ever wondered why some investors get paid first when others take all the risk in a deal? It all comes down to the capital stack, and today we're breaking it down in a way that's simple and easy to understand. Roland?
Yeah, thanks, Sarah. And we hear this term capital stack all the time, and people throw it around, and because it's used so frequently, we thought it might be good to do an episode on it. And this hook is really, you nailed you hit the nail on the head, so to speak. It's the question that everybody should be asking: when do I get my money back, and who gets paid before me, who gets paid after me? Mm-hmm. So I think that this is a good topic for everybody to consider for sure.
Exactly. And it's kind of a nice visual, isn't it? It's literally a stack. So, yeah. And you can visualize where you are in line that way, basically.
Yeah. Or what's the other analogy that's here? It's like a layer cake.
Oh yeah, it's a layer cake. The sweetest deal is the gooey bit at the bottom, maybe.
Yeah, maybe. Or that's the dried out part that's not worth
it depends on what your risk appetite is.
Yeah.
All right. So again, just to reiterate, why does the capital stack matter? The capital stack is actually just generally, it's the word that we use to talk about all the money that gets put into a company, right?
Yeah, for sure. We were talking before getting ready for this, and we can think about it in terms of debt and equity, right?
Exactly. And so, and there's some misconceptions about what that actually means, but the capital stack determines who gets paid first in a deal. It impacts your risk levels because the debt holders will be safer than the equity holders, but then equity holders have more upside. And essentially, on any given deal, where your investment would lie in the capital stack is going to help you understand whether that lines up with your risk tolerance, right? So,
yeah. And I think one thing that's really worthwhile mentioning at the outset is you can kind of think about what the expected returns are and the level of risk. And so generally speaking, debt will have a lower return, but because it's higher in the priority of being repaid over equity, it has greater certainty of being repaid. There's, no absolute guarantee that it'll be repaid, but in exchange for that lower rate of return, you have the greater certainty of repayment, but the equity has greater risk because it's behind debt, but it has a potential for greater return. And so there's this trade-off between, the perceptually safer debt at a lower return and perceptually higher risk of equity at a potentially higher. Did I say that correctly? Debt at lower, but lower risk, and equity potential for higher return, but definitely higher risk. So
exactly. And just again to say it, because we really can't say it enough, these are not rules. Every deal is different. And this is exactly what you as a potential investor in a deal needs to look for to make sure that what's actually in the documentation aligns with your understanding. But the general principle and the general rule is that equity usually means higher returns. Depending on the overall market, that might not be true, but it might still be a good deal. And the other common misconception is that debt is risk-free, which of course debt is safer, but obviously it still carries risk. If there's a distressed market and the company can't pay anything back, there's no guarantee. If there's no money, then nobody in the capital stack gets anything. But if there is money, the most senior debt holder would be the first to get a bite at that apple. I think sometimes I've heard people say first to get repaid something.
So, I mean, it's particularly important to understand these concepts now. We're filming this on April 9th, 2025. And I think it'd be remiss, any kind of intelligent discussion about, financial matters, we would really be kind of tone deaf if we didn't at least give a nod to what's going on in the public equity markets. But, it's just, again, really trying to educate here with the fundamentals and educate investors that maybe haven't thought about these concepts before. So particularly now, but always, always consider where you sit in the capital stack. And particularly now, if somebody's telling you that, the equity markets are melting down, so you need to go to debt. Well, that may not be true, so just be very careful in terms of if you lack understanding in this area, don't take what people are saying for granted. We're giving you education here about the fundamentals, and then just taking these principles and applying them to the real world scenarios is what we would recommend. But, obviously the markets are going crazy right now. What we talk about here are private securities versus public securities, and these are very different sectors of the economy. Right. So Sarah and I are actually pretty optimistic about the future. We're always optimistic, actually, but, I think we would want our audience members to recognize the opportunities for investment in the world of private securities. And this issue about the capital stack is something that is necessary to consider no matter what you're investing in, but particularly in, with respect to the private securities.
Right. And just to add to that, stick around to the end of this episode, because the capital stack is a neat little term that actually covers a great deal of detail and information. And it's actually something that it merits time to understand. But once you understand it, it will help with all parts of your investing structure, including if you're invested in the public markets, because you are still part of a capital stack when you buy equities in the public markets. So let's just get down into what the definition is. What is the capital stack if we wanted to have a formal definition, Roland?
Well, we form a company to go out and do something, commercial real estate or electric motor or whatever it is, and that company has to get its money from somewhere. And there are two traditional ways of funding the company, either through an equity investment. The founders might contribute, $100,000 of their own cash to cover all the costs of the company to get it started. Or you could get a small business loan, go to the bank and get an SBA loan to finance. And that SBA loan is debt. And so there are different ways of getting money into the company in order for the company to go out and start spending it to do the things that the company, the business entity, whatever it is, it's going to go out and implement its business plan. It has to have money to do that.
So exactly. So this capital stack is all the different layers of financing used to fund a company, which is essentially what you're investing in. And the reason for using a term and a concept like a capital stack is so we can understand in kind of like almost summary form how the capital of the company is structured and prioritized. So it's actually really useful. And you could even have a visualization where you imagine that there's a layered stack of blocks, and the base layers are more stable because those are lower risk, and the upper layers carry more risk, but obviously offer more returns if you can build that tower out of blocks bigger and bigger and taller. So that's the general rule. And as you know, like with any general rule, there are deviations from that. But this is essentially what the capital stack is. So let's dig into each layer, each main layer, Roland, because if you wanted to really get down into the capital stacks of some of these big, gigantic, publicly traded companies, they're extremely complex. But for our purposes here, I think it's fair to say we have four main layers. And which one do you want to start at the top or the bottom?
Yeah, the top. I mean, I think it makes sense because that's the question that mostly we deal with the equity investors, and they say, well, when do I get my money back? And you have to start by saying, first we have to pay company expenses, including current debt obligations, and that makes sense, I think, conceptually, because the third party lender hasn't made the same level of commitment to the company as an investor. Mm-hmm. An investor has read the PPM and they've evaluated the deal sponsor, the manager of the company, the people that are putting the deal together, and they've made a commitment in a different way. They've signed on understanding that they're the equity, that we're going to go out and combine this equity with debt, theoretically. Let's talk about like a commercial real estate deal, but this could be anything. And then the third party lender is making less of a commitment to the company, but in exchange for that reduced commitment, it's going to be getting a lower rate of return, theoretically, than the equity investors. And so it makes conceptual sense that the lower commitment investor should have the higher priority. I think that makes sense, right?
I think it makes sense too. And that's why you actually, as the equity investor, need all of this disclosure. That's what the requirement for a PPM, that's why it's a protection, right? Because, of course, a third-party lender will have its own due diligence process, its underwriting process, and there's a lot of information that is sought out for those purposes, depending on the standards of the lender.
Yeah.
But and also how much interest they're charging you.
Well, yeah, and it's interesting to think about like the due diligence that a lender does versus the due diligence that an investor does. And a lot of times, on the commercial real estate deals that we work on, I've heard this before, and this is a mistake of an investor, that they think they rely on the bank's underwriting to determine whether the deal is good or not. And that's one thing that I would probably warn people against is, that is it's an indicia that the deal could be good because the bank deals it to be creditworthy. But at the same time, you have to be skeptical in terms of, relying on that one thing, particularly if you're an equity investor and you think that, you're really wanting to target returns in excess of what the lender is expected to receive.
So I think that what you're saying, Roland, is exactly correct, because a bank, let's take a bank, it doesn't have to be a bank, that's your senior debt, but a third-party lender, it's typically considered the lowest risk, but it's also the highest priority. So there are two places that priority matters. Apart from, say, the deal itself and everything's going fine, well, before investors are going to necessarily get paid, there are terms of the loan that have to be met. That's one of the expenses of the company, really. But also in the event of a wind up or a bankruptcy or anything like that, the senior debt is the secured debt usually. They get the property. And if the property value is in excess of the debt, then there's something left over for everybody else. So that, because the banks go into it, or the lenders go into it knowing that they get that real estate, even if there are issues with liquidating real estate quickly and market fluctuations, et cetera, they still have something that over time has some kind of stable enough value. That means that that's probably their main part of their underwriting process, much less what the business says about what it's going to do. And then I think another thing is that banks themselves determine the risks that they care about in a property. Whereas in a PPM, you have what the sponsors of the deal need to communicate to investors about potential risks, but banks themselves have their own internal database and loads of experience usually with what risks and how they weight those risks. And it's probably different from how the company itself rates risk and how investors rate risks.
Yeah, for sure. I mean, that's a thing. And it's good to think about that, how the bank thinks about the debt versus an investor thinking about the equity investment. And
Exactly.
it's, like our deals, a lot of times the bank is putting in the largest single amount,
Right.
versus an investor. We may have a deal sponsor that's going out and raising money from 20 different investors at 50,000 apiece, and so the commitment from the equity is, I guess, lower in dollar amount, but,
Exactly.
well,
So it's almost like there's a reason it's on the bottom, and it's sort of like the bedrock foundation of the capital stack, right? The senior lender, right? And they have their own tolerance too. Most senior lenders like that can, it's not going to break them to lose one deal. So there's just a lot of differentiators between such a lender and an investor. Even though, just to be very for fullness, on complex capital stacks, you have a syndication of banks. You don't have just one lender, right, necessarily. So it's not like one individual lender is necessarily exposed to the full debt amount. But that, still each one individually is probably a much larger investor in these kinds of deals. Pardon me, I shouldn't say lender. Much larger stake of part of the capital stack.
Yeah, for sure. Well, do you want to go on to mezzanine debt?
Sure. So mezzanine debt, I've always found this such an interesting term, because what is a mezzanine? And what I've learned living abroad is that there's often a mezzanine floor between the ground and the first floor on the elevator.
Yeah.
And here in the United States, we don't do that. The first floor is the same as the ground floor. And so it wouldn't make sense to have a mezzanine between 1 and 2. But anyway, it's the same concept, isn't it? It's sort of like a balcony before you get to the rest of the capital stack.
Yeah, I've always wondered about that, but it makes sense when you explain it like that. And what were you going to say?
Oh, it's kind of like that balcony, that overlooking balcony when you have a really high atrium or something in a building.
Like hotels always have that.
Exactly.
That second floor, whatever. But so just to define it, it's a mezzanine debt can combine elements of debt and equity. So it can be a note that maybe is convertible into equity, or maybe it has warrants attached to it. So what that means, the warrants, the borrower is obligated to repay the loan amount, but then as additional consideration, in addition to the interest and any fees that are paid, the borrower is issuing a warrant, and a warrant is really just like an option to purchase equity in the future. And that's additional. It's called a sweetener sometimes, but the lender sees that as additional potential compensation, and they can go out and if the company goes on, it becomes a public company or whatever, you could go out and buy those shares immediately, sell them for a profit, and it could be a really good deal. There are lenders that specialize in that type of lending. So
I think you see private equity, these big private equity companies coming in as mezzanine debt a lot.
Silicon Valley Bank specialized in that for a long time, and they, had their demise recently, but that was just, I remember, working on some deals with some technology companies where they would provide that mezzanine debt.
Exactly. So just to reiterate, though, why is it that it often has higher returns? Well, there's a higher risk, right? Because it's going to be, if it's secured, it'll be second to the senior lender in security.
And it's often unsecured. And that's why that additional, either the convertibility feature is built in or the warrant, but that additional consideration that gives you the opportunity for more equity-like returns.
Exactly. It's an important area of debt that it actually, I think, is one of those great facilitators, right? Sometimes the mezzanine debt is a kind of a bridge loan that helps kind of keep a business going while the senior debt is being finally worked out, because senior debt also tends to be longer term, doesn't it? Or it probably should be. If it isn't, it has the potential to be.
Yeah. Maybe more to meet those short-term obligations. And this is kind of how it's related to risk, that to come in at that level, it really could be that without that financing, the company fails, but with the financing, it succeeds. And not only is that equity component to the mezzanine debt worth more, but all of a sudden, the mezzanine lender may wish that they could have converted, even more into equity, just because they've taken, addressed that short-term need that existed and allowed the company to just get over the little hurdle or whatever it is. So
exactly. Yeah. So I guess saying that, this has the mezzanine debt, it could sound redundant if you're accustomed to deals that only have one third party lender, like a senior lender, but mezzanine debt is really important. And maybe kind of often happens in the background, actually, without maybe fully being called mezzanine debt. It could just be called a junior creditor or second lien or holder or something like that. But it probably could be classified as mezzanine debt in the capital stack.
And I guess, the one thing to remember is, people look at your financial statements, because these will be reflected there, and full disclosure will provide you information about all the company's debt obligations. And if they don't provide that to you, then they're failing in their duty to disclose to you as an investor all the material information that you need to make an informed investment decision. So just where this can be found in the company's disclosure documents, for sure, they should give you a narrative written description of it, but then also it will be reflected in the numbers wherever they report those.
Exactly.
Okay, so, next is preferred equity. Do you want to do that next?
We mentioned it earlier, but there's this kind of number 2 and number 3, mezzanine debt and then preferred equity, we shift from third party lender, and mezzanine debt potentially, because of its convertibility feature, is a hybrid. But this is when you shift over into definitely being what would be considered investor in the business. And then that can be through debt or equity, as we were talking about earlier, right, Roland?
Yeah. And preferred equity is another kind of combination between debt and equity, but got to think about it carefully.
So probably most people who have invested in or sponsored commercial real estate deals or throw the term the pref shares around a lot, right? This is maybe the broader terminology for what that is, which is your preferred equity. What are the features of it?
Well, I think about this really, how we always include those redemption provisions and disclosure about the potential for redemption, or the actual, that is the term that preferred equity is at-risk capital, but so that means you could lose it in the sense that, it's not like a debt that's a contractual obligation to repay. And that means that it's further down in the capital stack. It's behind all the debt. But a lot of times what you'll see is the equity it's debt-like in the sense that the only return that an investor is going to get is a fixed amount. It's not going to participate. If the company strikes gold and has $1 trillion payday, all you get is this fixed return amount. And it can be low, but a lot of times on the commercial real estate deals that we've been working on, the preferred equity rate might be north of 12%, and so it's just a fixed return. And then, Sarah, let's talk about the redemption feature as well.
So, just also in addition to being a fixed return, there's often no voting rights with it, and potentially also some kind of priority when it comes to if there was a liquidation or a bankruptcy. And there was money left over after you get through the lenders, the third party lenders, then you'd find yourself with the pref equity usually. And in terms of the redemption, I think if there is a redemption, for example, then preferred equity is first in line for that.
Yeah. And that's, again, like it's equity at risk, but you're getting your money back there before the common, or for lack of a better term, we don't always call it common, but the equity holders that are really the highest risk, highest reward potential. So, the equity, the preferred equity kind of has a fixed amount. It definitely has a fixed amount that it's expecting to return. And I think just with respect to the redemption amount, the redemption feature what that means is once you get that fixed return, you're out of the deal. And that's disclosure that we provide to people, that if you invest in the preferred equity, once you get that, your money back plus the agreed upon return amount, then you're out, just like a lender would be.
Yes, exactly. And that's another reason why having voting rights, it makes sense to not really be too concerned about having voting rights. Because essentially once you're going to get this fixed money. Once you make that money, you're done. You don't have you haven't taken any decisions for the company. You don't have any ongoing obligations after you've made your money from the deal that you've expected to participate in the management of that company, for example, or have voting rights of some kind.
Okay. Anything else on that?
Let's see. You covered that we've got normally higher returns and maybe their liquidation preferences. And in general, I think with the preferred equity, it is one of those common terms in commercial real estate, at least, that's thrown around a lot. And actually, of course, it's something that's used in corporations and publicly listed or publicly traded companies a lot as well. And the theories are the same probably, but the way it's structured might have slightly different wordings. But let's see. So I guess we call this common equity, but that's just because you normally call stock common stock, right? So the way you described it before made sense to me, because it's really the highest risk, highest return. And often the common equity isn't just there are kind of two stages to it too, aren't there? Because of the waterfalls that we often see in commercial real estate deals. You're going to have the common equity, potentially you're going to have common equity that is what's after any kind of preferred amounts are earned. And then you're going to have the final common equity, which is often the promoters of a deal, right?
Yeah. So here's where you're really getting the participation in the profits of the enterprise. And what, the point you just made is that the people that are putting together the deal will have the carried interest or the share of profits to the management team, the sponsors. They'll have that built in relation to the common, really, because it's after all the debt is satisfied, all the senior debt, the mezzanine debt, all the preferred equity. It's really then at the common level, they're the investors that have put in the at-risk capital that ideally has the highest rate of return, but it does have that associated higher rate of risk. And that's where the promote, or carry fits in.
Yeah, exactly. And what's interesting here is that in this context, in the private securities world, when you are a promoter of this deal, you're getting this common equity, which is the highest risk, highest return, but you're also getting the highest amount of control usually, meaning you're involved in the management and the overall success of the deal. So that's, I think, a variation from what you might see in the public markets, where when you hold this common equity, you're relying on the efforts of the existing management who are expected to be professional management, et cetera, et cetera. But here it's also a great motivator, because it kind of acts as a protector to all the rest of the capital stack. Whether you think of the capital stack as bottom up with the third-party lenders on the bottom, or you think of it as top down with the common equity at the bottom, in the end, having management control with the common equity means, and active management means that they have to work hard to get paid.
Yeah, that's right. And so, like, if you think about the corporate governance aspect of this, the common equity, really, they're the shareholders that vote on things. And ideally, they're the ones that have rights with respect to the management. And a lot of our deals, we make the management the owner of the sole voting shares. And so if you think about that, then the investors, the holders of the common equity, don't really have voting rights. That's by contract. The default really is, like one vote per common share, or the preferred stock, maybe in a Delaware corporation that's an private equity deal. The preferred stock votes on an as converted basis with the common. So the preferred stockholders, and that's different from, that It's kind of like preferred equity, but we could get into the discussion about preferred stock versus common stock. But, again, it's just that concept of management control. And a lot of times the common won't have management control, but there'll be a preferred class of equity, of stock that's not preferred equity, but it's preferred stock, that does have voting rights or investor protections. The management has to go get approval from certain classes of the stockholders. And so then, really the common equity, it should just, be equity should be distinguished from preferred equity. And then the subclasses, I would say, would be preferred equity and then common stock, So there's just so many different ways of slicing this. And, part of your journey as becoming a good investor, for better or worse, requires you to, read these documents and really see where everything resides, but knowing what you're investing in and when you'll be repaid. Again, that's just the fundamental question about this entire episode.
Right. And actually it's good that we're getting into some of these complexities so that people can understand, any of our listeners can understand that if you're struggling if you feel that in any given investment that you're discussing with someone, let's say that you're not quite understanding what they're saying, it might actually be because it's a variation of the standard of what the capital stack is. Capital stack is actually not a simple situation, even though it can look simple. If all you see is a table and it looks like there are 4 or 5 line items on it, you can think this is simple, but it all comes down to how the rights that relate to each class are described in the specific deal, because the law governs some of what that is, but mostly it's the agreements between the parties and the promoters of the deal as to which parts of the common equity have the voting rights versus don't have the voting rights. And in fact, it's a little more complex than that even. You can have the voting rights to appoint the management, but actually there's still a couple of categories in the governance where all of the common equity holders would be voting on something. In the case of a catastrophe, for example, like the manager dying, you might have. So again, this brings us back to the point we're always making here, which is, you need to do your best to understand the deal that's in front of you. And we all understand also how busy life is and how realistic it is to be able to read all the fine print of every single paper that crosses your path. I don't know if anybody has time for all of that, but the fact is that it gets easier as you dig into these kinds of documents, and good deals will have documents that are also pretty well done and pretty well organized and as straightforward as possible when it comes to being able to follow them. So that's another indicator. If you're faced with a deal that you just can't get your head around, might be actually a red flag and a favor to you. So again, I think if we were going to finish up talking about this, Roland, I don't know if we're coming to a natural place to stop, but I think the main thing is that you need to understand the capital stack of the deal in front of you.
And it evolves over time, right? Like at the outset, all we have is a couple founders, and then they maybe raise the initial equity, and then the equity is combined with debt. And then 3 years later, they have to get a little more debt for whatever reason. And then a year after that, there's a new round of equity. And all of that can be justified and completely normal business operations in the context in which those deals are done. And you just have to, read through everything, and management has the obligation to disclose. And I think Sarah made the really good point that it just, these are difficult documents to understand sometimes. And of course, that's why we as attorneys have jobs, and we're more than happy to, talk with you about these issues. Representing investors is a pretty low contact representation for us. We typically like to represent the issuers, just because we make more money off those deals, frankly. But for sure, we'd be happy to talk with anybody if they have questions about what you're investing in and where it sits in the capital stack. I guess that's one idea that I would like to leave our listeners with, Sarah, is just to let them know that, this is the kind of thing where, I mean, I say this all the time with our clients that in this area, from a legal perspective, there are probably about 10 things that are unknowns to you. You don't know that you don't know these, what you don't know. And that's why you come to us. But, really just a little bit of education can be beneficial. And that's why we make this podcast. We're trying to explain this to people in a way that can be understood. And, again, we're targeting accredited investors here, but we think that there's a whole class of accredited investors out there that might be interested in investing in private deals. And we want to give you the information as investors from the context, from the perspective of an attorney, give you the information that you would need to assess this deal. So whatever.
What just occurred to me listening to you say that, Roland, was if I had to, if there were, sometimes you think through, like if you had to advise an investor on one or two things to really ask your sponsors on an ongoing basis, maybe this is one of those questions. Repeatedly over time, the longer you're with a sponsor, ask them, so how does the capital stack look? What's there in the capital stack?
Yeah.
Because where you started in the PPM is, as Roland said, just the beginning. And perhaps other things have been added. And maybe it was disclosed formally, or maybe some of it's within management's power to accept, especially when it comes to third-party lending or extending loans, or, maybe adding interest into principal amounts or anything. Things can change. And so that might be a question to constantly ask, because if it's a snapshot, it can give you a snapshot of actually where you stand with your investment.
That's why these conversations are so great, because this came to mind is typically, on these real estate deals that we work on, they're combining it's probably like, 60 to 80% debt, 80 would probably be on the high side and 60 is kind of on the low side, but, the rest is equity. But we have this one vacation property rental, they do short-term rental. It's a fund, and we haven't talked a lot about them, but they intentionally have made cash-only investments, and they disclose that they'll maybe get a loan to cover some operational costs, but they've really made it an intentional decision there to do cash-only investments, so have very limited debt. And so then that kind of reflects, well, do I really want that? And one answer to that is that the more debt that you can responsibly use, you'll get the equity will achieve a higher overall return, because the debt is limited to that fixed rate of interest. But yet the equity will enjoy the appreciation and the total value of whatever it is that you're investing in. It's a levered return. It's why real estate is so favorable. And so debt from a real estate perspective shouldn't be something that you're afraid of, but do note, looking at your investment, ask the deal, how levered will this be? Because the leverage creates risk. So that's one thing I was thinking about in terms of, that's a real life capital stack, and it's an example of a maybe a little unusual capital stack, because most real estate deals will use more debt. But they're a great company, and I hope to have them on as a future guest, honestly.
So what do you think, Roland? Is that a good place to stop? We can always do another episode on much further detail about the capital stack. Maybe we'll get some feedback from people about whether that would be interesting or not. So if anything else you want to add?
No, I think that's it. I think it's a natural place to stop, and it's a good conversation to have, particularly at this time where markets are in upheaval. It's an opportunity for all of us to learn more. And hopefully this is giving you more food for thought. Exactly.
So thanks everyone for joining us today on Alt Investing Made Easy. If you like this episode, please like and subscribe.
And remember, everyone, take aim with your alternative investing strategies.
See you next time.